Is everything that is based on past behaviors of the stock market and the company we are looking at. It is used for buy and sell timing, supply versus demand, and usually it's based on recent news and events with the purpose of a short term focus. Day traders use technical analysis a lot. I'm not a fan of technical analysis because all it does is to look at past graphic behaviors and try to predict the futures. The problem, in my point of view, is that you're competing with hedge funds like Renaissance and Six Sigma, which have terabytes of data compiling with their, billionaire top-notch technology, whilst you're a one-man show. So most people cannot make any money with technical analysis in the long term. Sure, you can have some luck for a while, but not in more than 5 to 10 years. A lot of those stock gurus that you can see on TikTok or Instagram, they are actually making money off you, not off technical analysis. So, however, that being said, if you still want to go ahead, there are a few of the things that I'm most passionate about with stock analysis when it comes to technical analysis. So, I did this quite a lot when I was very young. So, when I was 18, 19, which was over 10 years ago, I did a lot of technical analysis on commodities, stock, leverage, instruments, and if I'm honest, made a lot of money in the beginning and then lost it all. So that's why my kind of belief in technical analysis is not there. But I will tell you what actually has some substance to it because it does have some logic. So the first thing is support and resistance. So all that it is looking at the graph behaviors of a stock, you can see the past behaviors and where exactly the points where the stock is struggling, either to go further down or to go further up. Support is the latest, strongest line of which the stock bounces back from a downward trend. So as you can see here, you can see that, for instance, the graph here, it goes to this point and then it goes up. So that would be a support. A support gets even stronger if that occurrence happens more times. So as you can see in this graph, it happened 3 times. So the stock gets to that point, but it doesn't have enough momentum to break through and go down a little bit more. So when that happens in technical analysis, it means that investors are not pessimistic enough in order to let this stock go even further down. So therefore, whenever you see something like that, you want to buy the stock because you're going to break out. And similarly, conversely, you have resistance, which all that it is the opposite, right? Resistance, what it says is that the stock is ready to break out, but actually upwards instead of downwards. So once you hit resistance a couple of times, the stock is likely to break out and continue its movement forwards and upwards. So that what support and resistance are. And those are the basis of the most complex tools for technical analysis. So Fibonacci, in finance, Fibonacci retracement is a method of technical analysis for determining support and resistance levels. So Fibonacci is actually very interesting because it's something borrowed from finance. Fibonacci retracements are used to identify support and resistance lines and trade breakouts, though they can also be used for stop loss placements and counter trend target pricing. They are best complemented with other breakout indicators such as volatility tools and momentum. So this is an example of where you would use Fibonacci. So you can see that with the Fibonacci will give you the percentage of what the movement of a stock is in terms of looking at past behavior, how much of that stock would break resistance in the X amount of possibilities. And then if you look at with the tendency of the graph and where 1, 2, 3, 4, so with the level of certainty of where the stock is going to go, so the stock is here right now. So basically in 23% of the occasions the stock will break out that $27 amount. Again, is all looking at past behavior. Another thing that is used a lot, and actually I found that this is the thing that worked the best for me when I was trading commodities on a short-term basis, is moving averages. So here is another way, another tool to measure how the momentum is flipping the market. So you would have two different moving averages. Let's say one short term of 9 days, and the other one a lot more medium term, such as 30 days. Some people use 200 days. There are a lot of different ways of measuring this. The way that you select the days of which you want to measure the stock is based on how frequent you're trading. So if you're trading very, very, very short term, meaning every 5 minutes, then you want to use small data. So, for instance, 9 and 27 days as multiples. If you are trading maybe once a week, then you want to use longer term days. So that basically means, let's say, 21 and 200 days. So all that it is that whenever those two averages that you use they cross, that represents a movement in the momentum of that stock or asset. Could be any investment that you take. So if let's say that the blue line here is the short term line and the red is the long term line. So whenever the short term line has crossed the long term line upwards, that basically means that it's indicating that it is about to change the movement. So but you can see that it's not 100% reliable even in this case, because the movement, the long term movement was basically downwards. It crossed, but it was a false alarm because it went down. Now, the opposite happened here. It did work at this situation when the short term crossed again, moving upwards, and brought the long term with it, indicating that the investors were ready to revert the momentum. And then again, it worked well here. So it was a upward trend, as you can see, but then again, it crossed the short term over the long term, forming a golden crossover and reverting the momentum down. So that's how moving averages actually work. And people take moving averages and they put more finance into it, more mathematics into it, and they get to Bollinger Bands. Bollinger Bands is taking those simple moving averages, and basically what those moving averages are the averages of the share price over a number of days. However, you can see that it's very hard to predict with the moving average alone where the price is going to be. It's just giving you an idea of the movement of the stock. Bollinger Bands try to fill the gap. They try to give you bands of prices where the stock can go so that you can activate price stops if the stock goes too low, or sell targets if the stock goes too high. So it gives you an upper band and a lower band. Bollinger Bands is also very widely recognized and a popular choice. It's originated from Fibonacci because of their ability to confirm the breakouts based on an asset's current trading range. Congestion from a Fibonacci retracement can be seen as a particular telling if the upper and lower Bollinger bands have been contracting at the same time, confirming this likelihood of a breakout. Bollinger Bands are a type of statistical chart characterizing the prices and volatility over time of a financial instrument. So as you can see, all of those things are mostly used together to indicate the momentum of the market, and therefore you trade short term based on it. The final thing here to use together is the volume trading. What those candles represent, they represent the movement, but also the amount of volume. So whenever the candle is a big, chunky, fat one that represents a lot of volume, that basically means the number of samples of data being distributed is very high. So therefore you can trust a lot more on the analysis rather than those little sticks, because that's when the volume is very low. And anything in statistics, you might know this if you study it ever. The higher the number of samples, the more you can trust on a data sample. It's the same thing here. You can either look at the candles or you can look at the volume charts that your broker will provide. And the higher the volume, the more you can trust on your technical analysis. Before I move to the last part of this, nothing impedes that you use technical analysis with fundamental analysis. For example, you can pick a stock out of fundamental analysis that you want to stay in the long term, but you can time when to buy that stock via technical analysis. A lot of people do that. But as I said before, I think fundamental analysis is like 80% of making you successful. Technical analysis will supplement the other 20. So it's not really necessary. I want to say I don't personally use it anymore. I used for about a year or two in the beginning, but I found that, fundamental analysis I could achieve very excellent results without the headache, without the stress of trying to figure out exactly the moment when to buy a stock or an asset. Finally, there's a lot of candlestick patterns. Again, this is looking at past behavior. Is not 100% accurate, but there are some bullish candlestick patterns that indicate that the market will likely go up. Those are things like the hammer, the bullish engulfing, the piercing line, the inverted hammer, the morning star. Basically, what they usually do is this V of, okay, the market has gone down and now it's going up afterward. So there's a lot of this V, but there is also other forms such as just keeps going up. So I would say you can read this, you can familiarize yourself with it, but chances are you're not gonna remember this. And then conversely, is the opposite, is the bearish, is the opposite V. Hanging man, evening star, evening doji star. So it's different ways that it represents a bearish movement. I will leave these in the resources of this course, and then you can take it from there. I hope you like this brief analysis. I'm not gonna do examples because you're gonna see that the examples will only work 60-70% of the time. So, but I want to give you an overview of the main and most effective tools used by technical analysis. Hope you like this. Bye bye.